and welcome to the latest market update for the month of July with me, Andrew Dawkins, and
myself, Daniel Baylock. How's the month of July ended for yourself?
Well, the month of July was very good, and it's the first time in a long time that I've seen an Australian praying for rain, and you got delivered.
Oh, we did we? Not enough on that final day. Would have been nice for a couple more hours, but Ashes were retained, so that's all that really matters.
Yeah, well, they weren't one worthy down.
Retained back home where they belong. More important matters, how did the markets fare in July?
Well, I'm pleased to say it was a very positive month, and most of the investment funds that we looked after were in positive territory, and we haven't said that much in the last 18 months.
Good to get some positive news. What was the reason for the upturn in July?
Well, I think it was on the back of the inflation figures, which for most of the world were showing good readings and falling considerably. Still some areas, notably the UK, with very stubborn inflation rates, primarily due, and we mentioned this a few times, because of the silly way we fix our gas and electricity prices here. But worldwide, inflation looks like it's finally coming down. The banks, the central banks, are continuing to do their nonsense, which is raising interest rates willy-nilly, month in, month out. And I think we could rerun this piece since the beginning of the year, when we said, well, hopefully this is the last of the rate increases. And every month we say that, then the next month, oh, guess what, they'll put the rates up again. So by and large, in terms of the equity market, companies, and it's been a busy period for reporting figures for the month of July, most of the companies, especially the companies that we hold within the various funds that we use, are showing good profits, increasing the actual dividends, or looking at share buybacks, etc., right the way through from banking to technology stocks. So there have been some really good numbers, and profits are being increased through most of the companies that we own shares in, which perhaps shows that once again it was the whole reason for this inflation was because of consumers wanting to get out there and spend again. Companies are noting that for the future, revenues could be down as we start seeing the effects of higher interest rate feed through into the end user. So something to be aware of, I think, in the next few months is just how much damage potentially could be still reserved for later in the year, when the cost of people's mortgages, finance for vehicles, any other major purchases go ever higher. So a bit of a worry on that side. But when we're looking at the markets, they took comfort from the fact that inflation looks like it's coming down, and hopefully central banks will stop rate increases.
Looking at July and the different sectors and how they performed, what are your thoughts on that?
Well, the equity sectors worldwide have been very good, very encouraging, as money has come back into a number of the stock markets worldwide. Fixed interest, so lending money to companies, that started to show positive returns. So actually, in all the funds that we recommend on the fixed interest side, corporate, they're actually up this month. We're still a wee bit cautious ourselves about fixed interest, because if inflation starts to go back up the way, as we get into the autumn months, then that could see it elastically fall. But by and large, fixed interest now starting to recover. The lending money to the UK government has been a negative month again, as the bank continues to increase interest rates, so then the price of gilts and gilt funds reduces. Long term, this will come good as the bank's rate increases plateaus, and then going into next year will start to fall. So probably gilt in the UK and probably worldwide as well will start to increase in price. Perhaps not immediately, but certainly into autumn and then the winter and the spring months. So looking long term, which is where we concentrate our efforts anyway, then it's still that sort of a sensible part of the portfolio to have. The other area which actually, I think this month there's only been two areas that have been negatively affected. So one is the gilt, as we've talked about. The other area has been the Far East, the emerging markets, which have suffered because Again, China hasn't caught fire as much as people would have expected. However, as we said last month, the difficulty with China is that it's a different mindset. They're not spendaholics like we are in the West. The other thing is that a lot of consumers over there have got the fingers burned with property investments. So the property side in China is still very much in trouble because, funnily enough, they built probably too many properties, whereas here in the West, we're probably building just the opposite, too few. So China has dragged the emerging markets and the Far East market down. Japan's come off the boil a little bit, but it had a sparkling first 6 months of the year. So that was the case that perhaps a bit of profit taking is going on there.
It's good to hear some positive news, as we've been saying. So in summary, what are your thoughts on the previous month, and I guess looking forward as well?
Yeah, so on the back of falling inflation, hopefully central banks getting the message that actually increasing rates does more harm than good. If they can get their fingers out and start holding rates or even then reducing them as we go through the winter months, then things are looking quite good. For us, long term, actually, although there's been a lot of pain over the last 18 months, it's a good springboard for the next section because we've been buying assets at a cheaper price, which is always good. It's the way you want to be. As long as you're buying quality, then if you're getting it at a cheaper price, eventually when it recovers, you get more for your money. If you buy rubbish and you get it at a cheap price, you still end up with rubbish. So that's the bottom line here. So long term, we're still making money. The future is looking a lot brighter than it has been for many months. And as long as we don't get too much damage from the central bankers increasing interest rates and the feed through from that, then we're in a very good position for the next year or three.
As we do every month, we look at the ARD consultancy portfolios and their performance over the 1 month, 1 year, 3 years, 5 years, and 10 years. We'll start with the defensive.
Defensive over the last month up 1.3%. Over the last year down 2.6%. Over 3 years down 11%. Over 5 years we're up 5%, and over 10 years up 55%.
And the cautious portfolio?
This month we're up 1.2%. Over the last year down 1.6%. Over 3 years up 1%. Over 5, 11%. And over 10 years up 82%.
The balanced portfolio?
This month up 1.3%. Over the last year down 1.7%. Over 3 years up 6%. Over 5 years up 17%. And over 10 years up 112%.
And the capital growth portfolio?
This month up 1.3%. Over the year down 0.8 of 1%. Over the last 3 years up 14%. 5 years 24%. And 10 years 134%.
And finally, the aggressive portfolio.
This month up 1.3%. Over the year up 0.5 of 1%. Over 3 years 23%. 5 years 34%. And 10 years 158%. First month in a long time where all portfolios are up in value.